Welcome to Mrs. Moneybags Live. This episode is sponsored by quickequity.ca, getting you to your money fast by providing customized mortgage solutions to clients across Canada. I am your host, Nicole Williams, aka Mrs. Moneybags, mortgage agent level 2. We go live Monday to Friday, keeping you posted on the latest financial news, developments, and economic news, helping our viewers make informed decisions about their money. Reminder to do your own research. This show is intended for informational purposes only. Let's get into it. Let's discuss today's mortgage industry headlines. So here is your summary of mortgage and housing news from across Canada for Thursday, January the 18th, 2024. Let's get into it. How was your evening? How was your day, everybody? How was the day going? So we're going to discuss mortgage rates. So fixed mortgage rates are on the decline. Is now the time to lock in. Rates on some fixed mortgages have dropped by a full percentage point in the past few months, opening up an opportunity for Canadians eyeing the spring housing market or with a mortgage of their own up for renewal. While experts say there's little downside to securing a cheaper rate today, committing to a long-term mortgage with rate cuts in the forecast might end up costing some households more in the long run. Before the end of 2023, the lowest rate available for an insurable 5-year fixed-rate mortgage dropped below 5%, the first time it fell below that benchmark since last spring. As of Thursday, rates are as low as 4.84% were available for the same product at multiple Canadian lenders across our platforms. That's down more than a percentage point from the highs seen last year. Since late October, there's been a shift in sentiment within the bond market that informs what rates banks offer on mortgages and other loans. As the Canadian economy has weakened and inflation has shown signs of cooling, forecasters are shifting their expectation for the Bank of Canada's policy rate from higher for longer to now thinking rate cuts are coming sooner than later. That's driven downward yields on products like the Government of Canada's 5-year bond in recent months, the key benchmark for fixed-rate mortgages of the same length. The popular 5-year fixed product is not the only mortgage seeing cheaper rates to start the new year. 3-year fixed-rate mortgages are also down from recent highs, floating just above the 5% mark. Because yields, and by extension fixed mortgage rates, are tied to the expectation for the Bank of Canada's policy rate, anything that pushes back forecasts for eventual rate cuts could send fixed rates in the market back up. Inflation could stay elevated, for example, keeping the central bank from easing rates. Such a move would limit activity in the housing market as fewer people qualify for rates they can afford. At that time, market watchers began to speculate that rate cuts were on the horizon, bringing down yields and fueling a spring thaw in the cooling housing market. But those hopes were cut short in June and July when the Bank of Canada returned with back-to-back rate hikes, and the bond market saw yields surge soon after on the higher for longer mentality. For that reason, there's never a downside for Canadians who are thinking about getting a mortgage for the first time, or who have one coming up for renewal in the months ahead, to get a rate hold now when the market is easing. By inquiring with a mortgage professional, you can secure a rate at today's prices, typically for 120 days in advance of when you need it. If bond yields continue to ease and rates drop further, you can take advantage of the new rates right up until you sign for your new mortgage. If the trend reverses and rates rise, you're similarly protected. How to secure the most competitive rate. The 4.84% rate available on from most lenders is typically available to home buyers or buyers with an insurable rate mortgage. An existing lender is likely to offer a competitive 5-year fixed rate at renewal, but will be more inclined to negotiate a lower rate if you're working with a broker to put another offer on the table. There's another option for mortgage consumers to consider: a variable rate mortgage, which are currently more expensive than most fixed rate options as they're tied to lenders' prime rate, which itself is informed by movements in the Bank of Canada's policy rate. Currently, 5-year variable rate options are priced around 6.2 to 6.7%. But if forecasts are to be trusted that the central bank rate is going to decline, those with a variable mortgage could see their rate drop in concert with those cuts. Depending on the type of payment involved in the mortgage, a household could see their payments start higher but drop as the rate cycle eases if they were to take on a variable rate mortgage. There are plenty of risks that come with this approach, as happened last year. Rates could still rise rather than decline in the years to come. But it should be noted that if rates cuts do materialize, a variable rate holder could pay less than someone with a fixed rate over that same time frame. Consumers in the marketplace should start pricing that into consideration. Coming off a very cool winter season, which saw few active buyers and some would-be sellers forced to shelve their plans for the new year, there is a prediction that the housing market is due for a strong start to the year. There should be a lot of pent-up demand just because there weren't a lot of transactions last year. So what are your thoughts on the predictions? And, it's not even a prediction, it's just where the interest rates are at the moment. So we are seeing 5-year rates, for the most part, below 5% for insurable rate mortgages. And the thought is a lot of individuals are saying, should they lock into a 5-year? Again, another attractive interest rate is the 3-year term. But again, do you want to lock in with the thought that rates may continue to decline over the next 12 to 24 months, or even perhaps even longer? So again, having the variable option is always an option for clients, because as the variable rate allows for you to take advantage in market changes, if the rates were to continue to decline as predicted, you too would see a change in your overall rate and potentially a change in your payment. Again, keeping in mind that the risk of rates not declining could be a possibility, or they go in the reverse. What are your thoughts? Drop your comments below and let's get this discussed, because I think there's going to be a lot of individuals, as we know, between 2024 and 2026 with mortgages that are coming up, and this is the big question. What should I do? Should I lock in for the 5-year term? Should I go shorter term? And should I do fixed or should I do variable? This is the big question. Drop your comments and your thoughts below in the comments, okay? Let's get talking about that. So Trudeau announces $9.18 million for housing in St. John. Okay, so this is very interesting. Let's get into this article. Trudeau announces $9.18 million for housing in St. John. Prime Minister Justin Trudeau was in St. John, New Brunswick, Wednesday to announce the federal government has reached an agreement with the city to fast-track 285 new housing units over the next 3 years. Under the Housing Accelerator Fund, this agreement will provide $9.18 million to help meet the housing demands in St. John. We've worked very, very hard with the city of St. John to come to an ambitious proposal that's going to increase this densification, that's going to accelerate the process in terms of building more houses more quickly, said Trudeau at a news conference in St. John's. They are looking at freeing up public land for housing. They are looking at all different things that are going to not just make individual projects happen, but change the way all housing is built in this country, and by extension, right across the country. Trudeau said the federal government signed housing accelerator deals with cities that were willing to be bold and ambitious about meeting the growth that Canadians want and need. It's about building a better country for everyone in which people can have that building block and that pathway toward greater and greater success by having a secure and affordable place to live, Trudeau said. As a city, the mayor of St. John is saying, St. John is dedicated to accelerating the development of affordable housing. It's a pivotal moment for St. John as we collaborate with the federal government on the Housing Accelerator Fund. As a small city with a big heart, we have to be bold and we want to grow. As part of the agreement, St. John will cut red tape, reduce requirements, and accelerate approval timelines for missing middle units. Work to reform its zoning bylaw approvals, use public and underutilized lands for housing development, implement a new permitting system, work with nonprofit and private home builders to coordinate, fund, and develop affordable housing projects. So that sounds pretty interesting. Let's see how successful St. John is at achieving the 285 new housing units. And what hasn't been discussed here is how they're going to achieve this. So we know they have over 3 years to achieve this goal. Again, they have been allocated $9.18 million. So it will be very interesting to see, outside of, cutting the middleman and implementing new permitting systems and et cetera, how the city will effectively utilize these funds in order to achieve the housing goal. As we know, Canada is basically in a housing shortage. And the more money that we are putting towards these projects is great, but it's about not wasting the funds and ensuring that the funds are adequate based on today's society, based on inflation, to meet the project's goals and timelines. So that would be very interesting for us to continuously watch and see. So again, St. John's, 285 new homes, new units. Okay, so we're going to go just through 2 articles today, simply because a lot of the articles are a bit of a regurgitation to what we've already discussed this week. We know inflation is high. We know the interest rates are coming down. We know we have a housing shortfall. And we don't want to necessarily keep on regurgitating the same information over and over, because we're here to provide solutions and to be, yes, we want to report on the news and want to know what is happening and be at the forefront, but we also want to be as proactive as possible. So with that being said, we're going to get into our financial tip of the day. So the financial tip of the day is to tackle your debt. We will all tackle our debt in 2024. So there are 3 things we are to do, okay? Start off by A, we must know what and who we owe. So I would like everybody to make a list of all the creditors, all the lenders that they owe. A, you're going to start off by tracking what is the dollar amount, what is the interest rate, if there's a monthly fixed payment, what is that monthly fixed payment, and when is that debt to be killed. So when I say killed, I mean, when are you going to be finished paying that debt off? And you're going to track all of your expenses. Once you've tracked all of your expenses, you're going to then reverse engineer it by tracking from the highest credit limit to the lowest limit. So if you have, let's say, a credit card that is $15,000 and another that is $10,000 and one that is $5,000, your list would look like the 15, the 5, the 15, the 10, the 5, okay? Then you're going to create another list that talks about the interest rate. So you're going to go from the highest interest rate to the lowest interest rate. And then you're going to start off by saying, okay, well, this credit card is 19.99, this loan is 11.99, this car payment is 8.99, and you're going to track them accordingly. From there, you're going to have a clear plan of A, the debt that is outstanding. So we should know the total amount that is outstanding. B, we should have a listing of from the highest debtor to the lowest. And then we should have a list of the highest interest rate to the lowest interest rate. We're going to have a game plan of implementing a strategy of either using the debt snowball or the avalanche. The debt snowball or the avalanche in order to kill these debts. 2024, we're getting our debt under control and we are going to eliminate and kill the debt. That is the financial tip of the day. Today's Mrs. Moneybags money affirmation is, I attract lucrative opportunities that create wealth. I attract lucrative opportunities that create wealth. Let's say that again together 3 times. I attract lucrative opportunities that create wealth. I attract lucrative opportunities that create wealth. I attract lucrative opportunities that create wealth. That's all the time we have for today. Thank you for tuning in to Mrs. Moneybags Live. We'll see you again tomorrow.